So that's where we are today. Our very first session. I'm not big on introductions. I'm just going to invite Sam and Sarah to come up and do their own introductions.
Your choice. Oh. Would you like to go first with introductions as well? Shall I while you're doing the mic? Right, hello everybody. Good morning. Sam Gervaise-Jones. I lead bfinance's investment consulting business in the UK and Ireland, and I'm also an independent advisor to a public sector pension plan. I wanted to thank and congratulate Fiera for getting me out of the house and in a suit, which I couldn't quite stretch to putting a tie on. That is actually a bit tight. Sarah.
I'm Sarah Butcher. I work at Fiera as their capability specialist across private credit. So I represent all of our private credit teams across three kind of broad collateral types, which would include corporate direct lending, real estate development lending, and infrastructure finance.
And that's a neat segue actually into the conversation. We're here to talk about private credit. I'm sure many investors in the room have some exposure. Some may even have exposure without realising it is private credit, because there is, as Sarah mentioned, quite a wide spectrum of asset types within there. Do you want to maybe just spend a moment defining that so we know we're all on the same page?
Sure, absolutely. So broadly speaking, private credit is just non-bank lenders lending to private companies or projects. Our strategies at Fiera really focus on downside protection. There's a lot of different ways to access, private credit across the market. There's a wide swath of opportunities, but really what we're doing is lending capital with the expectation that we're going to receive a contracted yield and return of principal at the end of the day. Private credit is not a traded asset, so it is a buy and hold strategy, and there's really no exit other than getting your capital back at the end of the term loan.
That's great. John mentioned it's the fastest growing of the private market sectors or asset classes, shall we say. I suppose a lot of that growth is coming off the back of probably the financial crisis and the retreat of banks from certain types of lending. But is that really all that's driving it, or are there other things that you see?
So certainly the great financial crisis accelerated the growth of private credit. The bank retrenchment that was mandated really as the outcrop of that event really created a void in the market for private lenders to come in and really provide financing for businesses, and in our case, mid-market to lower mid-market type businesses globally. There was non-bank lending prior to the GFC, mostly focused on insurance lending or more mezzanine or opportunistic credit. So the mid-market direct lending business really is an outcrop of the GFC. I think a lot of the growth in private credit has come from the unique aspects that it brings to a broader portfolio conversation. So traditionally, remember when interest rates were low, strategic asset allocations to fixed income were really not providing income in a portfolio. And so large institutional investors primarily were focused in the asset class to create that incremental yield or that stable source of incremental income compared to what they could get in public markets. Fast forward to where we are the last year especially, the risk characteristics of the asset class have become that much more important, and certainly creating the next wave from mid-sized, smaller pensions, even some retail family office investors really looking for the risk mitigation that the asset class can bring to a broader portfolio construction. So it has lower correlation from a beta perspective. So as we saw, public equity and public fixed income betas correlate, private credit is a nice diversifier to those asset classes as well. And then also because the income is contracted and it's a buy and hold strategy, the investor really does get that very strong consistency of return over time, not subject to kind of the volatility that we see in public markets.
No, that makes a lot of sense. It's something that bfinance has seen a lot of client activity over the last 5, 6, 7 years across lending to assets, sort of real assets, as well as the corporate side, and largely driven by that sort of yield enhancement, people really needing to find a way to generate income, to pay, either pay pensions or pay other liabilities, but also just to generate enough return to meet their targets. I suppose there is a change. Inflation is with us. It doesn't look like it's just a blip and it's going to go away anytime soon. That's undoubtedly the last, well, all of this year you've probably seen rates rising. Is that a good environment for private credit?
Yeah, it's certainly a conversation that we've been having a lot as we kind of look around relative value between public markets and private credit. Does that liquidity premium still exist? I would say absolutely we're still seeing incremental yield in private credit for comparable risk levels. As John mentioned, most of private credit in our book as well is floating rate. So as rates rise, we do benefit from the higher base rates in terms of our overall yield in our portfolios. In addition, our teams are investing into this environment, and so their loans are pricing, even floating or fixed, are pricing in higher absolute yield returns. So, top line level, we are seeing the income potential of our portfolios also increasing in this environment. Now, I would also argue on the flip side in terms of relative value, if you think about public market volatility, maybe lack of liquidity when we would have wanted liquidity in public markets, I would argue that the risk characteristics of our public credit markets have increased, as we've seen volatility increase over time as well. So, certainly those yield differentials are dynamic, but I would say over the long periods of time, the complexity premium that you do achieve in private credit certainly seems to be alive and well, and we're still seeing, 200 plus basis points premium for a comparable risk.
And one of the I suppose criticisms of some of the private credit investment managers that's been levelled over the last few years is that they're very new, they've not seen market cycles. How important is that? Does it really fundamentally change the way investors need to be thinking about making loans?
Yeah, I think that's an interesting point, and I'm certain from your consulting seat that's something that you absolutely look at when you're evaluating managers as well. I think having workout experience, learning from things that don't go well, investing through market cycles, I think is absolutely important. And so the way that Fiera has been able to build our platform has really been to find kind of specialist teams that have deep experience in a given part of the market. And so I think that, 15, 20 years investing through cycles in your area of expertise. And I think that feedback loop, that learning is really important in terms of originating the loans. So these are privately structured loans. Contracts are negotiated. And so understanding and having experience with where potential pitfalls are should things be a more challenging environment, I think is going to be very important to differentiating managers that do better and those that maybe will struggle at this point in time. So yeah, absolutely, I think that experience is important. And then I would also say that certainly in times of challenging environments, creating a larger opportunity set with which to select credit is also very important as well, and it goes back to experience. So unlike public markets where you can pull up a Bloomberg screen or a bank interface to pick your loans or your investments, in private markets you have to originate your own opportunity set. It's finding your own transactions, and so having that experience through cycles, longevity with borrowers is really important to create that large funnel from which you can also then be very selective or picky in terms of what deals you're underwriting.
You mentioned two hugely important words there. Opportunity, one, and origination. John mentioned the continued interest in private equity and growth in the asset base there. And though, the private equity and private credit worlds are very closely linked, right? I think it's fair to say, this year private equity kind of deployment activity has slowed, and therefore, I guess, deployment on the private credit side has also slowed. How is it that that's not going to be a problem for investors committing to private credit today?
Sure. So absolutely, we've seen private equity activity slow from like an M&A perspective, but there's still substantial numbers of portfolio companies that still need financing. And the dislocations in the public market have really limited opportunities for financing through other avenues. The bank loan syndication market is basically shut. It's the slowest we've seen since the GFC, which is, an avenue where some of these borrowers might have found credit opportunities as well. So it is absolutely true that M&A activity from private equity has slowed, but the number of businesses that need to access our type of capital as a percentage of all businesses has increased, if that makes sense. So while the top line might be smaller, our kind of portion of opportunities that would fit something that would be interesting to us has commensurately increased in the market dislocations. So as a result, we're actually finding some very attractive, high-quality businesses that maybe otherwise would have accessed cheaper sources of capital, frankly, through the syndicated market, are really looking for lenders to provide capital. And so we're able to increase the quality of businesses that we're lending to very, very high quality credit while still generating the yields that we need for our investors, both because there's not a lot of options for these borrowers, and then also because of rates rising more broadly. I would also say that private equity, because it has grown so much over the last several years, does still have a lot of dry powder itself. So even though activity has slowed, we would expect over the next year or so to continue to see private equity firms looking for opportunities to deploy that capital. And so there will still be a natural source of opportunity set for us as well.
And what about you're describing fewer sources of capital for people to come and actually borrow from. Are you seeing that in terms of less competition from asset managers as well on individual deals?
Yeah, that's actually a really interesting nuance to the current environment as well. I was actually speaking to a friend at a competitive firm right now, and they're entirely focused on their current loan book. So firms that have been investing capital over the last 5-7 years through kind of the glory times post-COVID, where there was a lot of opportunity, are now really focused on managing those loans through the more challenging environment. We're very fortunate that our teams have joined Fiera more recently, as John mentioned, as we've continued to grow our platform. And so we don't have large legacy books. So we can be very much in the market sourcing opportunities. And so, absolutely, there's still lots of competition out there. There's lots of great firms that are trying to take advantage of market dislocations as well. But, there are certainly many teams that really need to be focused on managing their deals in their book. So we are finding that it's become definitely more of a lender's market, and that we're well positioned to take advantage of it, frankly.
We might come back to it being a lender's market when we talk a bit more about responsible investment, because I think there's some interesting aspects there. But before we go in that direction, I was wondering whether the sort of time to deploy is changing in your mind, because as with most private market investments, it takes time to build a book, right? You almost can't put it all in on day one, and you probably don't want to be that exposed to the circumstances at that time anyhow. Is anything changing there? Is this still a sort of a 2-3 year build out of a portfolio and then start to harvest, or are you seeing that change?
Yeah, so actually I was having a conversation with an investor recently who was asking just this question. You know, if the opportunity is so great, are you just, you know, putting all the capital to work right now? And I would say, absolutely, you want to have dry powder in this environment where you do have the flexibility, where you do see opportunities that you can act quickly. But you do want to be measured and make sure that you're really stress testing from a diligence perspective, really spending your time on credit, getting outside expertise when necessary, really doing your homework to make sure that you're not getting the wrong credits into the portfolio. Unlike private equity, where you can have some deals that do really well and some that maybe you don't talk about, in private credit, you need every deal to fire. So it's really important to do that work. So we want to be measured in our deployment pace. In terms of, 3-year investment period and then a harvest, we actually manage both types of fund structures at Fiera. So we do have strategies where it is a 3 to 4 year investment period and then a harvest, so a typical closed-end fund structure. And they will continue to pace out their deals over that investment period. And then we actually have open-ended perpetual funds as well. One of the challenges in private credit, because it is so cash generative, is actually staying invested. And so a perpetual fund is more like what we see in public markets, and so you're able to stay more heavily invested as you can reinvest your capital as those distributions come through. So for our open-ended structures, we're really trying to pace out how much investor capital we accept versus the deal flow that we see, so we can kind of match those out. So we have an appropriate pool of dry powder in order to be, nimble in terms of deploying capital, but also being conscious of the fact that we do want to be moderated in our deployment. So we kind of see that, and I would say time to market, we're being pretty consistent, frankly. So our investment period in both types of strategies, we have multiple folks working on multiple deals, but 4 or 6 months of diligence is not unheard of. And certainly we're seeing a very wide funnel, and we're growing our teams to help whittle that funnel down quickly. But we're still, when it really comes to the investment process, we're really sticking to our investment process to make sure that we're, fully vetting the opportunity set.
And are you seeing any change in some of the covenants or the types of kind of structure that you're lending against? Because I think that's something that a lot of investors kind of worry about in the good times. Is it a bit lax? You just need to deploy capital, but also this kind of, it sounds like you're not reducing your return expectations. So what is it that we're doing to make sure that the risk side of things is kept under control as well?
Yeah, so certainly, covenants have been front of mind for many. Cov Light was a term that many might have heard. As I mentioned earlier, we really focus on the mid-market opportunity set, which we think is less competitive and a better risk-return trade-off. Because it's less competitive and because we offer a unique source of capital, we've always maintained full covenant protections. So we think that's important in part of our underwriting, and one of the reasons why we do make sure that we're very diligent in maintaining our fund size. So we don't grow our funds too large because we don't want to be pushed into the large end of the market. So what we did see from a competitive standpoint, going back 2-3 years, as these fund sizes grew really large, deal sizes also commensurately had to be big in order to populate those funds. So if you have a $6 billion fund, you're not going to be writing $50 million tickets. It's just not a good use of labor. So there was more competition at the higher end. So that background, all that to say, as we're sitting here now, I would say that those deals that maybe were covenant light, maybe didn't have as much protection, are the ones that our competitors are really focusing on. But as the pendulum has now swung and there's a different competitive dynamic in the market where there are less options, a lot of those deals might have gone to syndicate markets. Now they're coming back, into direct lending. So the pendulum has definitely swung in the favor of lenders. We are seeing covenants broadly kind of come in. While we've always had, full covenant protections, we have seen that covenant protections the lenders are including more and tighter covenants. And then we're also seeing borrowers are trying to also be more creative in, EBITDA add backs and, trying to work around those covenants as well. So certainly the diligence on managers has also become, the diligence from managers has also become tighter to make sure that businesses are performing. The point of a covenant is really to create a conversation. And I think that is one of the important points of private direct lending versus the public markets, is because it's a direct relationship in many cases with the business owner. Those covenants created an opportunity for a conversation, and then we can work with them to get better outcomes. So broadly speaking, yes, covenants are coming in a bit. And, Fiera has always maintained, full covenant conversations in order to have better outcomes more broadly should there be challenges.
I want to make sure we have some time for questions, but before I just got that one thing about responsible investment, because across the board now, I think certainly in Europe, investors have fairly well-defined ESG policies, in many cases specific carbon targets and related issues. How is that coming through on the private credit side, and what can you do? Because there's always that sort of question as to it's just lenders who no one listens to you.
It is different being a lender than being an equity owner. We don't have, board position. We don't have proxy voting rights. Really, our biggest stick or impact is at the point of origination. So the easiest thing for us to do is just decline. So, top level, we are focused on sort of a negative screen, and that comes back down to your funnel and your sourcing, right? So if you have a lot of opportunity, if something isn't right for, any reason, whether it be, you don't like the financials, you don't like the governance, you don't like the engagement with local communities, then you can decline a deal. And so that's often the kind of the first level of our ESG. We certainly also want to support businesses that are going to perform well over the next, 3 to 7 years of a term loan, and longer for our infrastructure strategies as well. So we do want businesses that are growing and changing and adapting to current market environments. So we actively support, businesses that are part of that transition, such as, solar power, biogas generation. And also we have, manufacturing, offshore manufacturing. Before doing a loan, for example, we mandated that a third party audit the manufacturing operation to make sure that they were meeting kind of social obligations to their workers. So if they hadn't been able to pass that, then we would have declined to lend money. So there are some triggers that we can do, but really the best thing to do in any loan is to get it all out of the way before you kind of write that check.
Makes a lot of sense. Let me throw it open to the floor. Any questions that you have come? Nima, do you want to just say who you are, actually? I might know, but everyone else might not. And there's a mic just behind you.
Nimashi Sivayogan, Head of Treasury and Pension at Lanambra of Merton, a local authority pension fund. Thank you, Sarah. I'm just going to touch on the last point you described on the ESG. As Sam mentioned, it is far more important than return for us at the moment. And you mentioned that you do the screening and everything before you write the check, but we expect much more than that on an ongoing basis. We want you to report, and that is expected from us. So how can you guarantee you don't stop checking on the ESG once you're given the money? We wanted to see continuously that you are checking. That's all.
Yeah, thank you. That's a great point. A very important part of our process is the ongoing monitoring of our loans and our borrowers. So we do heavily resource our teams so that they don't have too many loans in their portfolios, so they do ongoing follow-ups on the loans and their borrowers. So we will make sure that our borrowers are maintaining our expectations for ESG. We do provide regular reporting to investors as well, and we certainly are working towards enhancing that reporting. Frankly, one of the challenges in mid-market lending, if you think about the businesses that we're supporting, some of them are coming up the learning curve as well. And so we're certainly partnering with our borrowers to enhance their processes and reporting, provide access to our extensive in-house ESG resources as well, so that we can work to improve together. Because I appreciate that the level of reporting and transparencies, that it's important to our investors, is also evolving as we all kind of learn together. So we certainly encourage that type of partnership really through all our stakeholders.
We've seen across the market kind of just patches of lending where actually lending rates are tied to some sort of ESG KPIs. Is that something that you think can be a meaningful engagement with companies, or is that just greenwashing?
No, I think there are certainly, many different ways to encourage businesses to kind of up their game. Our strategies aren't directly, the ESG type strategies that are including those types of metrics currently in our portfolio. But certainly the types of businesses that we want to be supporting, are focused on kind of longevity of their businesses. So I absolutely think that that's an interesting idea in terms of trying to create better alignment in the lending space. And I think there's lots of evolution to come, as we continue to kind of build portfolios into this evolving space, for sure.
Great. Any other questions on the floor? Yes, sir, in the middle there. I can't introduce you because I don't know you.
Versus say a year ago, if you're sort of launching a private credit fund now, would we expect the kind of increase in cash rates to come through in your sort of investment targets or investment objectives? And is it kind of on a one-for-one basis, or is it sort of more complicated than that?
So, going forward, it will depend on the path of interest rates. I would like to, pretend that I know exactly what that's going to look like. The expectation is that we probably have a little bit more room to go, and so we'd expect to see maybe some additional lift in our yield expectations in our portfolio. For floating rate loans, it is basically reset based on like a SOFR or a base rate level, usually on kind of a quarterly type roll. So that would basically be a one-to-one as those base rates reset. For our fixed rate loans, it's less of a direct relationship, but it's a case of, a rising tide lifting all boats. So as kind of the general market interest rates increase, our relative attractiveness is still intact, and so we generally kind of keep our spread, if that makes sense. I think that at a certain point we need to be a little bit careful in terms of how much debt servicing costs businesses can really withstand. And so this goes to the flip side of that interest rate question, which is credit quality. And so even more so as we continue to see interest rates rise, we need to be really careful about the stress test that places on our businesses, and not lending to businesses or structuring packages that don't suit the credits, because we don't want to negate our interest rate gains by then having credit losses. So I think we probably have a little bit more to go, but our portfolios, we'd rather go up in credit quality and maintain kind of, those returns that we've promised to investors over time. We're certainly at the high end of our targets, rather than just keep pushing that interest rate higher and risk, the businesses being unable to support it. I hope that answered the question. Yeah. Okay.
My handy timer says 2 minutes, which is exactly right for one more question.
Sarah. Rupert Sheldon from Fiera Estate UK. And just picking up on Nima's point, in our real estate leases, we have green lease clauses. And they put certain obligations on tenants to report and to comply with relevant ESG regulation as it evolves. And failure of tenants to comply is a breach event, and we have legal recourse in the usual way. Do you see the private credit markets going that far? You talked about monitoring, but do you see the ESG becoming covenant compliant issues? And do you see there being legal recourse in the event of non-compliance? Or do you think that's a bridge too far in the private credit world?
You know, that's an interesting question. I think we're certainly not there yet. It's hard to, opine on where we end up. And it also is I think, market dependent as well to a certain extent, because we do manage global portfolios and in different kind of communities. ESG is more or less emphasized in terms of standard practice, frankly. So I think we're moving towards it. There's certain assets that might be better aligned. For example, real estate, having KPIs or covenants that are reflecting, carbon footprints, I think are easier to calculate. Infrastructure, certainly, we can see, biomass fuel where you could have a more clear alignment. Some of our smaller, service-oriented businesses, family-owned, it gets a little bit more complicated, I think, for those types of business owners, but I don't think it's impossible. I think it's an evolution, and how far we end up, to be honest, I'm not really sure.
Great. We are out of time. 0000. Thank you very much, Sarah. It does feel like an asset class that there is plenty of opportunity going forwards, but maybe it's not going to be quite as straightforward as throw your bucket in the sea and pull out the fish.
Yeah, I'd agree with that. I think with any active portfolio, in times of market dislocation, turbulence, volatility, you see more dispersion amongst managers. So there's going to be those that perform well and those that perform less well in this market environment, and we feel very confident that we're set up to do well for our investors. So thank you.
With that, I'll hand back to Eric. Thanks very much.